Gabrielle, can you share the screen?
Yep, absolutely. Hold on one second here.
Okay, looks good. Can everyone see the screen? Yep.
I can see. Yep.
Everyone's good. Okay, so today we're doing a presentation on Proposition 19, which is a very significant piece of legislation. There's been some confusion in the news. Today, our goal is just to give you high-level information about the legislation and have you figure out what, if anything, is the right thing for you to do. So this is Nicole Meerstad. I'm the owner of Vista Properties and the CEO of Vista Properties and the hostess for today's meeting. So we're going to talk about Proposition 19 and how it relates to both the escrow process and wealth management, as well as any kind of real estate decision-making. So Brielle, next slide. So we're going to have some key speakers on this call. Our first speaker will be Sal Covarrubias. He is the AVP from First American Title. So he will give us a high-level overview of the legislation as we know it, as well as some real examples of what this might mean for you as it relates to real estate decision-making. Our second speaker is a wealth manager / consultant, Carl Warden III from Tax Deferral Strategies, LLC. And Carl will walk us through some scenarios of how to manage tax protection as it relates to real estate and decision-making as it relates to Prop 19 and otherwise. We will have a short presentation from Jose Mendoza, who is a local mortgage broker, owner of Karma Mortgage, who specializes in all types of real estate loans and financing. Finally, we will have an afterword from your meeting facilitator and hostess, Nicole Meerstad from Vista Properties, followed by a live Q&A session where you can direct questions to the speakers. So I already went over this. I shared our goals for today. We're providing high-level information about Proposition 19 and what it means for wealth management and real estate decision-making. Please seek the expert advice of your tax advisor, attorney, financial planner, and other trusted resources for wealth planning. We are here to give you high-level information about Proposition 19 as we know it, but before making any decisions, please go to your trusted network of advisors. We are not attorneys, and we are not trained or certified to give you specific advice on this call or about your specific situation. There will be provided contact information and further resources, as well as a copy of this presentation. So just relax and watch what is said. The recording will be available to you. So back to the Q&A. In the interest of time and due to the volume of people on this call, and to be efficient, please post your questions to the chat as you have them. We will pause on each slide to answer immediate questions to the specific slide. And if you have something else on your mind, please bring it to the live Q&A that will be at the end of the session, noting that please keep it relevant to the group. No one likes another to do, but these resources are published by the California Association of Realtors, also known as CAR, and the assessor's office here locally in Santa Cruz, and they're valuable resources to further educate yourself on Proposition 19. And so without further ado, I'm going to hand it over to First American Title, to Sal.
Wonderful. Thank you so much, Nicole. I really appreciate you and Vista Properties asking me to come and speak to the group today. And so good afternoon, everyone. My goal today is to do a broad overview of Prop 19, talk a little bit about the legislation, and then give you an idea in practical terms of what that means and how that'll affect your upcoming title and real estate closing. So by way of introduction, my name is Sal Covarrubias. I'm the Bay Area Regional Sales Manager for First American Title, and I've been with First American in the settlement and closing industry for 19 years. So with that, let's move into the presentation and talk about the overview on Proposition 19. There are two primary changes to Proposition 19. The first one is that it replaces Prop 60 and 90 in relation to the transfer of residential tax base to replacement property for eligible parties. And so we'll talk about that in detail in the following slides, but that basically is essentially is a tax benefit. For people that are eligible parties, you can now transfer your tax bases in a much broader scope than you could under Prop 60 and 90. That's the first change, and that's a really nice benefit. The second change is that Prop 19 affects or changes intergenerational transfer of tax base and how the tax treatment to the tax base. In some cases, and I would say in particular in Santa Cruz, because of the price point in your marketplace in that county, it will amount to a tax increase in intergenerational transfer, where in the past, that may not have been the case prior to Prop 19. Those are the two big changes. Again, this is very broad, very general, but let's go into those changes and look a little bit, how they affect. So the first is transfer of tax base to replacement property. What we're going to do is we're going to look at what that means pre-Prop 19 under 60 and 90 and post-Prop 19 with 60 and 90. So we're going to show you a graph there. And so the first thing there is eligible person. So moving on to eligible person, pre-Prop 19 under Prop 60 and 90, an eligible person was defined as 55 years or older or permanently disabled. Under Prop 19, it's the same, however, it now includes victims of a wildfire or a natural disaster, regardless of age. So that's one of the big differences under Prop 19, and a benefit, obviously, to the people that are victims of a wildfire and natural disaster. And speaking specifically to Santa Cruz, that's a boon. Unfortunately, we know that there were some victims of a wildfire this year, and that's tragic. So this is a benefit to them in terms of helping them with their property tax base. So moving on to eligible property, looking again at the difference with under principal residence and eligible for homeowners exemption. And the replacement property must be purchased or newly constructed within 2 years of the transfer. Under Prop 19, it stays the same. Principal residence and eligible for homeowners exemption, and the replacement property purchased or newly constructed within 2 years. We're going to talk about the effective date here pretty soon, which I might as well mention is April 1st. So it's coming up in a couple of weeks. However, what we can do is, going back prior to April 1st for the replacement property, right? Because it's the same as 60 and 90 within 2 years. Most people sell their primary residence first and then exchange that into the replacement property, or transfer into the replacement property. But you can do it opposite, okay? So that is allowed under Prop 19 as well. Now let's talk about the replacement property location. In the past, Prop 60 limited to transferring your tax bases within the same county. So Prop 60, intra-county, had to be in the same county. Prop 90 asked counties to opt in. And so there were about 10 counties in the state of California, 10 out of 58 or so, that opted in to Prop 90. So you could see the vast majority didn't. One of the big benefits under Prop 19 is that under Prop 19, the counties do not need to opt in to allowing the transfer. You can transfer to anywhere in California.
If you want to
No
move
county approval is needed.
you transfer
So
your
this
tax
is a
base.
huge benefit. So before, you couldn't go to certain counties, now you can. Now let's talk about the number of times that you're eligible to transfer the tax base. Under Prop 60 and 90, you could do it one time, and that was it. So there was a limit. Under Prop 19, you're now able to transfer 3 times, and it's unlimited for the victims of a wildfire or a natural disaster. And it's horrific to think that somebody is a victim of wildfire or natural disaster once. It's incredible to imagine that they would be victims 4 times. However, it is really nice that that is there, unlimited for their benefit. I will share a quick story for you. We have a closing in our Los Altos branch that was scheduled to close on the 29th. And it was somebody using Prop 90 to transfer from Santa Clara County to Alameda County, which was allowed under Prop 90. However, they worked with the buying agent, and the buyer's agent agreed to extend the transaction. The buyers agreed for 2 days so they can change the transaction to April 1st. So instead of transferring the tax bases under Prop 90, they're going to be transferring under Prop 19. What that does is it gives them 2 more times to transfer the tax bases. So if Livermore doesn't end up being their forever home, they could then transfer the tax bases again to San Diego or Riverside or wherever, right? So that's a huge benefit under Prop 19 versus Prop 90. Now let's talk a little bit about the max value of the replacement residence. Under Prop 60 and 90, the requirement was that it had to be equal or lesser than the original. There was a little bit of leeway there. If it was replaced within 1 year, you got an additional 5%, or within the 2 years, you got an additional 10%. However, more or less, it had to be equal or lesser value. If you sold your property, your primary residence, for $800,000, you couldn't buy a property for $850 and transfer your tax bases. It just wasn't allowed. However, under Prop 19, it is going to be allowed. You can transfer your tax bases for any value. If it's greater, they are going to tack on the additional value in terms of a property tax. We'll show you what that looks like. But the original tax base does transfer with you. That's also a nice benefit of Prop 19. So let's see what that looks like by looking at the new tax bases. So under Prop 19, or excuse me, Prop 6090, it was the same as the original residence. Transfer of tax base only allowed if equal of lesser value. As you can see with this, it can be for greater value, and we'll show you an example here shortly. And the start date is April 1st, as I mentioned. All right, now let's take a look on the next slide of that transfer of calculation example. So we're going to start with your old tax base plus the new property cash value minus the old property cash value. Okay, so excuse me, the formula is old tax base plus the new property cash value minus the old property cash value. So let me show you what that looks like. Original purchase price is 400. Old tax base is 500, right? Because property tax went up over the years. And the old property value is 900. Bought it for 400, paying on 500, now worth 900. And you're buying a property in another county for 1.2 million. Under Prop 6090, not allowed. Under Prop 19, it is. So how do we calculate what your new tax base is? We take the 500 and we add the difference between new value and old value. So the difference between 1.2 and 900,000 is 300,000. We add that to your old tax base of 500, and your new tax base is now 800,000. So I don't have access to the chat box as I'm viewing the presentation, but if there are any questions on any of the slides I just showed, please type in the question, and somebody that's monitoring the tax box or the chat box will let me know. All right. How does this affect your next closing in terms of the property tax base transfer in real terms? Well, it's the same as under Prop 60 and 90, essentially, with a couple of differences. The first is it's the homeowner's responsibility to file the base year value transfer form with the assessor, just as it was under 60 and 90. That's the same thing. Okay. So here's the thing. Right now, if you go to any county assessor's website to look for these forms, which are pretty standard forms, they're created and put together by the California State Board of Equalization. Those forms are there. However, they don't have the Prop 19 forms out just yet. I know the start date's on April 1st, so they should be coming soon. And if they're not, you can always talk to the assessor and let them know that this is your intention and that you will be filling out the form as soon as it's available. I will advise this. Don't take advice from anybody other than the assessor, because it's their responsibility to implement this legislation. So they're going to be the ones that'll be the right people to talk to. So the next bullet you'll see here is making sure that it's the homeowner's responsibility to file that transfer. Now, the first way that you notify the assessor that there is a transfer and put them on notice that you are going to be taking advantage of Prop 19 is on the next bullet, which is your preliminary change of ownership report. We call it the PCOR in our branches, and the realtors and lenders refer to it the same way. The PCOR is provided by your escrow company. And it's the responsibility of the home seller, home buyer, to make sure that it's completed correctly. We do deliver that to the recorder's office as part of your recordable package. In some cases, it is recorded. In every case, though, it's separated from your recordables, and that PCOR is sent off to the assessor's office. So it just lets them know what and how this sale was for their taxable purposes, and they make note of that. However, they're really going to be looking at your base year value transfer form with assessor, because that's what really lets them know, hey, I am transferring my tax base. And also, because this is only to your principal residence, you will have to fill out the homeowner's exemption form as well. So make sure your PCOR is correct. Make sure the 2 forms with the assessor is correct. Definitely call the assessor to make sure that you understand their process and that you're doing everything that is required in order to take advantage of this. As I mentioned, this effective date is April 1st, and as of yet, there is no base transfer form from the Board of Equalization. So if you're having a transaction on or after April 1st and your intention is to transfer your tax base, definitely call the assessor of the county that you're transferring into and make sure that you understand what they're looking for. So that is essentially the first part of Prop 19, which is the transfer of tax bases. Now we're looking at the second part, which is the treatment of the tax bases for intergenerational transfer tax, transfer of tax base. So again, same as the last slide, we're going to be looking at pre-Prop 19 and post-Prop 19. That'll be the header on this, and moving into what eligible person is. Pre-Prop 19 and post-Prop 19 is the same. So this is a situation where a parent or a grandchild to a child or a grandchild is transferring their property. Usually, this is upon death. As you can see here in the top left corner, the effective date is February 16th, 2021. So the effective date of this portion of Prop 19 has already passed. Before, for the transfer of tax base, we had mentioned it was April 1st. For intergenerational transfer tax base, the effective date has already begun. So going forward or currently, it will be under this new tax treatment. So looking at eligible property, Prop 19 does change this quite a bit. So pre-Prop 19, the family home of the transferor, parent or grandchild, without limit and value, and other properties collectively valued up to $1 million could be transferred from parent to child, grandparent to grandchild, and you would get a step up, and you would transfer, the property tax basis. So you would not be paying any additional tax, property tax, child and grandchild. Under Prop 19, this is limited. So only property used as a primary residence, family home, by both the transferor, so parent, grandparent, and transferee, child, grandchild, and a family farm is accepted. So investment properties or primary homes that are inherited by a child or a grandchild that are then going to be used as a rental will no longer get the benefit of the property tax rate of the parent or grandparent. They will be reassessed. The only time you won't be reassessed is if it's used as a primary residence or was a primary residence by the parent or grandparent and will be a primary residence of that child or grandchild. A lot of questions around this. There's still a lot of questions by the assessor's office as to how effectively they're going to do this, what is needed by the parent, or excuse me, by the child or grandchild. And the Board of Equalization has received a letter from the assessors, passed that on to state legislature, asking for clarification. Currently, what's being asked is that that child or grandchild that inherits this property is going to need to file that homeowner's exemption form, claiming it as their primary residence, and they'll need to do that on an annualized basis in order to take advantage or the benefit of taking that property tax base without being reassessed. So that's a major change, okay? And it may change some things that you might want to do in terms of tax planning and those types of things. And so we'll get to that in a second. That's not my wheelhouse. We'll have another speaker for that. I'm just doing the overview. So let's look at the new tax basis. So pre-Prop 19, the new tax basis for that child or grandchild was the old tax basis, right? They just took it and it was fine. With Prop 19, there's now a formula that you have to apply to see if it's going to be reassessed or not. Like I said, with the price points in Santa Cruz, oftentimes it will. So if the value at time of transfer is less than $1 million more, okay, less than $1 million more than the transferor's tax basis, then the tax basis of parent or grandparent transfers to the child or grandchild, okay, if it's less than $1 million more, okay. So we'll show you an example of that. If value at time of transfer equals or exceeds $1 million more than transferor's tax basis, then we apply a different formula, okay? So there's two separate formulas here. Let's look at the first one. The first thing here, 2A, if the value of the property, so mom, grandmom pass away, God bless them, and daughter, granddaughter inherits the property. If the property's value is less than $1 million, then that granddaughter and daughter take the old tax basis. Not a problem. Now, parent to child, if the value of the property is more than $1 million, we still have to apply some math here. But in this example, the parent or grandparent's tax base is $300K, right? The assessed value at the time of transfer, their death, is $750. So the grandchild's tax base would be $300, right? Pre-Prop 19. But we have to determine to see if it's less than $1 million. So 750 minus 300 is 450K. So 450K is obviously less than $1 million. Therefore, the tax base transfers as is to the grandchild or child. Now let's look at a different example. On the next slide, we'll see that there can be a reassessment. So starting with the parent or grandparent's tax base, their tax base is $425,738. Maybe they bought it for $100, maybe they bought it for $200, but they're paying property tax on $425,738. If the value at time of transfer, remember, equals or exceeds $1 million more than the transferor's tax base. Well, how do we figure that out? We add $1 million to the tax base. So $1 million to their tax base is $1.425 million. Okay. Now we have to determine the value of the home. The value of the home is 1.7. 1.7 million is clearly more than 1.425,738. So now we have to take that difference of the 1.7 and the 1.425,738. That gives us 324,262. This is the additional value that they're going to be taxed on in terms of property tax. So you're going to add the 425 to the 324, and you're going to get 750 as the new combined year value that you will be reassessed for. I was just on the phone with the Santa Clara County Assessor's Office yesterday, and again today, at Alameda County on the 23rd, I'm meeting with them. They're all going to have calculators on their websites sometime around April 1st. What they all have now is a letter from the California State Board of Equalization giving this exact example that I just gave you. So I didn't make it up. It came from the Board of Equalization so that you have an understanding of the equation so you can apply it to your own specific situation. Okay, so moving on. What does this mean in practical terms? In practical terms, in many cases, it's a new day for estate planning. So since the effective date has already passed, Again, please consult with your estate planning professional to adjust your estate plans as necessary, or if at all. A lot of people aren't doing anything, right? They're just kind of waiting to see because there are still some questions. And obviously this is based on your specific needs. And as Nicole mentioned earlier, I'm not an attorney. I don't provide legal advice. So you're definitely going to want to reach out to a trust attorney, and in many cases, a tax professional and a tax strategy professional. Fortunately, Nicole's put together a pretty good team. So she does have a tax deferral specialist on this presentation that you'll hear from shortly. So on the next slide, we're going to talk a little bit about how this affects your next closing. Very similar to the last situation. It's the homeowner's responsibility to file a parent-to-child exclusion form with the assessor within 3 years. So the parent or child takes ownership. They have to fill out a parent-to-child exclusion form with the assessor. This is a different form from the first form that we talked about, right? So make sure you're filling out the right one. Most assessors say within 3 years because that's what the legislation is for Prop 58. However, I would advise that you don't wait 3 years. I would advise you don't wait at all. Fill that out as soon as possible so that the assessor is aware. It does take them 3 to 6 months to process these, so just keep that in mind. I will add that at this point, it is expected that child or grandchild files the homeowner's exemption form annually, as I mentioned before. Now, this is one of the key points that is being addressed by the Board of Equalization with state legislature to make sure that they still get that transfer of the tax base, but the assessors really don't want to audit this on an annualized basis. So they're trying to figure something out with legislatures on what that looks like. The last thing I'll say is seek advice from your property county's assessor. I know I've mentioned that a few times. However, it's important that you get direct advice from them, as they're the ones that are implementing this legislation. So last thing, from a practical perspective, is if you are transferring your tax basis or you are looking at a parent-to-child exclusion, make sure that you are filling out the correct forms. If it is an escrow and it's a transfer of tax base, talk to your escrow officer and let them know. Same as if you were doing a 1031 exchange or any other type of tax deferral transaction, so that they're aware and that she can prepare the appropriate documentations and provide the appropriate documents. And then seek advice from your assessor. So with that, if there are any questions, I'll take them in the chat box. Otherwise, it's my pleasure to introduce Carl Warden III from Tax Deferral Strategies, LLC, because now that you have an understanding of what the legislation is, you'll have some questions as to what you could do to possibly defer taxes down the road. So without any further ado, please welcome Carl Warden.
All right, thank you, Sal. That was incredible. Man, that was really well done. Thank you. Great job. It's a pleasure to meet all of you. And Nicole, I am honored to be a part of this panel. Thank you for inviting me. If you can go ahead and go on to the next slide. Give you a little bit of my background. I am a registered investment advisor. I have been a real estate investor for nearly 30 years. I've owned numerous properties. I am also real estate licensed. I don't actually have the license to pursue the business of listing and selling properties. I have the license for a couple of reasons. Number one, I'm a real estate investor, so it gives me the ability and the opportunity to get a discount on the acquisitions of the real estate that I purchase, as well as discounts on the sales of my real estate. But in addition, I actually teach the topic of tax deferral all over the United States, including 90 different real estate offices throughout the San Jose, San Francisco Bay Area. I am a representative, facilitator for a 1031 exchange accommodation, actually a couple of different companies. And I've really, decided to make my specialty tax deferral. I look for ways and reasons why you can literally avoid paying taxes on the sale of anything with a capital gain. So as it relates to real estate, we have multiple different strategies. Baby boomer generation is making lots of changes at this point, looking to downsize, looking to move closer to kids, grandkids, simplify their life by, downsizing their real estate investment portfolio, et cetera, et cetera. So go ahead and go to the next slide. So, ultimately, when somebody comes to me with a property that they would like to sell, be it a primary residence, a second home, an investment property, we have the ability to defer tax on the sale of all these asset classes. The 1031 exchange, which most of you are probably familiar with, is very applicable to investment property. But for most real estate or residential real estate offices, that strategy is applicable for maybe 5% of the overall transactions. The rest of the transactions are primary residence and second home. And we do have options for those. And when somebody does come to me, I'll have you know that one of the first things we do is we actually look for a reason why the client doesn't need us, which I know is counterintuitive because everybody's trying to sell something these days. But we have something called a TRQ, stands for Tax Reduction Questionnaire. The purpose of that questionnaire is for you to take it to your CPA, and you and your CPA collectively can go over the questions. The questionnaire is really designed to incentivize or get your CPA to focus on other areas of your overall financial situation that they otherwise might not have looked into. And ultimately, if we can get that tax issue down to zero or close to zero, then as far as we're concerned, we've done our job, and you don't need us. So we do really act in the best interest of the clients. But when we do find a client that does have a primary residence or second home or even investment property, we look at what we call the anatomy of the deal. And basically, when you purchase a property, you have an original purchase price that you paid for the property. Perhaps, many years ago, you didn't pay very much in comparison today. So you have your purchase price, plus you have your capital improvements. And then above and beyond that, you have your capital gains. So purchase price plus capital improvements equals cost basis. And then you have your capital gains above and beyond that. And that can largely be sheltered through what's called the 121 exclusion. So if you're single and you've lived in the property as your primary residence for 2 out of the last 5 years, you get a $250,000 exemption. In other words, you don't have to pay taxes on the first $250,000 of capital gains. If you're married and you've lived in the house for 2 out of the last 5 years, each of you qualifies for the $250,000 exemption for a total of $500,000. So if you go to the next slide, this will be better illustrated by showing you, this example. So a married couple selling their family home, they originally purchased a property for $700,000. They made capital improvements in the property of $100,000. It should say capital improvements, by the way. Some people think, hey, if I replace the carpet, is that a capital improvement? It is not. If you did a garage addition, room addition, kitchen or bathroom, complete renovation, put a new roof on it, things of that nature, those are considered capital improvements and can add to the basis of the property. So basis is, the 700,000 plus they put the $100,000 in it in this example for a total basis of $800,000. This particular house is being sold for 1.3 million. Do they have a tax issue? Well, in this case, no. They have the 1.3 plus your $800,000 of basis, less the 121 exclusion, the $500,000 exemption. And so their capital gains tax is zero. They don't need me. If you go to the next slide, this is actually something that we find pretty common throughout the entire Bay Area. Married couple bought their home years ago, paid $400,000 for it. Again, put $100,000 of capital improvements into the property. Their basis is $500,000. Now their situation's a bit different. We got a sales price of $2 million, and this is definitely more common in the Bay Area. You subtract out the basis of $500,000, take the 121 exclusion from that, and here's your capital gains tax of $1 million. So, the next slide is, this is the elephant in the room. Okay, there's a lot of people that are somewhat happy about Prop 19, but the biggest issue for for a lot of folks is not just the property tax or keeping the property tax base, but having to pay the tax on the capital gain. And there's many different taxes that come into play. You have obviously the state tax, which can be upwards of 13.3%. You have the federal tax, which it can be upwards of 20%. You have Obamacare at 3.8%. And the collective of all three of these is 37.1%. So Prop 19, although it reduces your property tax bill, it doesn't resolve the issue of your capital gains tax. So what we do is, we show people how. I like that. I never saw the X. We show people how to overcome this problem. So, and I'm happy to tell you that recently we discovered that there's actually a way for you to capture the basis out of this property tax-free, while at the same time capturing the capital gains portion tax deferred. So in the example that we gave you, where the tax is roughly 37%, let's just call it 30% to make numbers easy. If you had a capital gains tax of $1 million or capital gain of $1 million, you could pay upwards of $300,000 in taxes. This means you have $700,000 left over. $300,000 is a lot of money to lose. You figure if you were to invest that money, yourself, you would, at 6%, something conservative would give you an extra $18,000 a year. Well, we have ways where you'd actually be able to keep not the 700, but the full $1 million. And that essentially equates to an extra $18,000 a year of income because you didn't pay the tax. So we are tax consultants. I appreciate Sal saying expert or specialist. The tax code is roughly 70 to 80,000 pages, depending upon what website you look at. That includes both tax code and case law. I will never refer to myself as an expert. I have made it a study, arguably over my entire life on how to avoid paying taxes, but now I've made it a profession. I'm fortunate that I have amassed a team of tax attorneys, CPAs, trust attorneys, and these folks are part of my team. We help you legally keep most, if not all, of the money working for you. And I'd like to put in a little plug for Nicole, if I might. I do teach this topic, as I stated, all over the United States, various real estate offices. I've taught at CPA offices, but specifically as it pertains to real estate offices, I will tell you that, when I meet with a client, oftentimes, and it does happen fairly frequently, it is actually in the best interest of the client to keep the property. Now, most real estate agents don't want to hear that, because most real estate agents are, or I won't say most, but a lot of them are more concerned with making a commission than they are, doing what's right for the client. I will tell you, there's a number of real estate professionals in Santa Cruz County, and Nicole is one of them, that, she puts the interest of her clients first. And so regardless of whatever it is that I tell the client, she's more interested in what's right for the client. And so what we do is, we work with the client, we provide the answers and solutions, and ultimately make certain that it is in the best interest of the client to move forward. We do have multiple different strategies, 13 on the platform currently for reducing, minimizing, or deferring the tax. We can reduce income tax. We can reduce taxes on the sale of capital gains. We have businesses, we're able to reduce taxes for them as well. But ultimately, I can answer any questions at the end here. And this is some of my contact information. So anyway, without any further ado, as it was stated earlier, we're going to take questions at the end here. I'm going to go ahead and turn it over to Jose. There's some of my contact information. And again, pleasure speaking with you. Thank you. And Jose, it's your turn. Oh, maybe he's got it on mute. Do we have everybody muted? Was I muted?
No, we could hear you just fine, Carl, but it sounds like Jose's on mute. So Jose, you may have to unmute on the Zoom screen.
Sorry, guys, just 1 second here. I'm trying to get him.
Nope, looks like he's unmuted.
Jose, can you hear us?
Hey, yeah, I can hear you guys. Can you guys hear me?
Yes.
Did you want a better introduction, Jose? I'm sorry.
No, that was great. Thank you, Carl. So, yeah, great presentation, both of you guys. What I wanted to say was, I guess, a different perspective for this, that as I understood the interpretations of Prop 19, The good thing is that it's still possible for us to transfer a property and take advantage of the benefit. So I have a question for folks. What motivates our purchases of homes, whether they be primary, investment, or second homes? Is it tax law? So even as the laws change, sometimes it is irresistible to buy a property that we've always wanted, or that our spouses sees and falls in love with it. Or just it's a property that makes sense for us in the lifestyle we wish to live. So I'll tell you a quick story. I got into real estate about 16 years ago when my wife fell in love with scuba diving. And we wanted to figure out how to purchase and finance an investment property near the ocean. So I put my master's in computer engineering into high gear. And as we figured this out, we quantified it and wove it into the very fabric of Karma Mortgage Solutions. We have a saying at our office: we are solving the world's problems one loan at a time. It is built in with us. We have a passion for real estate. We like math. We are problem solvers. And being OCD is okay for finding those solutions and helping you figure out how to successfully purchase your real estate dreams. Now, back to the topic at hand of Proposition 19. Again, I'm not an expert. There are experts out there. But again, this is just my opinion that the tax ramifications, for my part, I'll say this, that we do our best for our children, our grandchildren, our friends, and even for the charities to whom we will bequeath our lands. We do our best. So trust in the professionals you have in your team so that you do your best to find a way to share the beauty of the real estate gems we come across in our lives. Call upon your CPA, your lawyer, your estate planner, your realtor, Nicole Merstad, your wealth management, Carl Gordon, to successfully help guide you in the intricacies of making decisions when buying and selling real estate. That's my 2 cents, if you will, everyone. So now I would like to introduce you to a business colleague that I hold with the highest professional regards. Please help me welcome Nicole Merstad from Vista Properties.
Hi, team. This is Nicole from Vista Properties. If you don't already know, Vista Properties is a Capitola, California-based real estate brokerage specializing in real estate sales and property management. So we manage over 50 properties and we're specialists in all types of real estate transactions. We're kind of small but mighty. I call us a boutique firm. We have a solid team of listing and buyer agents and top producing realtors on our staff. So let's talk about me, because I love to talk about myself. I'm just joking. I'm the founder and CEO of Vista Properties, and I'm a licensed realtor. I was the winner of the prestigious California Association of Realtors Rising Star Award in 2019. I've sold every type of property possible. I really just threw myself in head first to make sure that I knew how to do it, whether it was land or commercial buildings or things that other people don't want to take on. I took them on and I learned. And I would say that every single type of property has been covered. So now is the time that I'm going to tell you why Proposition 19 matters to you. You could trade up. So formally under Prop 60, Prop 90, they made you trade into something lower than your sale price, but that's changed. So if you want to, you can trade up. You can take your tax base and trade up. So you can go into a superior property and protect your capital gains. Maybe you want to trade down. Maybe it's, too much house. Maybe it's something you want smaller, something easier to manage, maybe something single story. You can do that as well. The main thing is part two of the legislation is very complicated, but you need to consider your heirs and what it means for them and you. So what it means for them to be saddled potentially with the tax basis versus making a decision now to get into the right thing where you can transfer your base under point number one. Do what you want. This means, hey, I'm over 55. I'm going to travel the world. I'm going to get out from under these saddlebags and I'm going to go do what I want to do. You can do whatever you want and you have a lot of options. And then finally, it makes sense to figure out what makes sense to shelter your wealth and not just give it to the government. Talk to the wealth advisors, talk to your CPA, talk to the trusted people in your network. Take advantage of Proposition 19 and what it means for sheltering your wealth. And now just a really quick little ditty about my team. These are my first slide. We have Team Vista Properties, Sandy Hockman, Dana Rasmussen, who's both my property manager, and one of my top brokers, Greg Weber, my broker of Greg Weber, broker of record. Rialberto, Matt Mora, both top producing agents for Vista Properties, kind of apprentices. Gordon, who's been in the business for over 25 years. These are all resources for you if you're interested. So I'm happy to share presentation materials both from today, but also from the California Association of Realtors, which will follow in the appendix. Now we're going to open it up to the Q&A session. So what I'm asking is just direct the question to the specific presenter if you can. Otherwise, we'll figure it out. Go ahead, guys. Go ahead, Cheryl.
I did make a note here. So the value of your house and land, your property tax, is different than the real estate market value?
Yeah, Cheryl, I can take that one. So yes, the property that you're assessed by the county assessor, the assessed value is different from the market value. And that is specific to Prop 13. So Proposition 13 limits how much the county assessor can assess your property. Typically, that's no more than 2% a year, although it does fluctuate. So when the market's down, they can reassess your property down. Your property taxes can go lower. Some of us experienced that in 2009 and 10 and 11 when there was a big downturn. But yeah, so for example, maybe somebody bought a home for $100,000. It goes up 2% a year on average, right? Because of Prop 13. But the increase in the market value outpaces the increase in the reassessment. So it's possible for somebody to own a home that's worth $1 million and only pay property taxes on, say, $650,000, for example.
Hey, Sal, sorry to interrupt, but can either you or Carl speak to what happened to the former legislation of 60 and 90 and 13 and all of these propositions? Are they in play anymore, or did Proposition 19 take over them all? I think it's a very important topic.
So Proposition 13 is still in play. That did not change. That's still part of the California Constitution. And Prop 19 is now also part of the California state constitution, which is one of the reasons why it's so hard to make changes there. So Proposition 60, which allowed people to transfer their tax basis, eligible persons to transfer their tax basis on their primary residence within a county, and Proposition 90, which allowed the same thing for certain counties, both will sunset this year on March 31st. And Proposition 19 will take the place of Prop 60 and 90 completely.
Okay, so basically Prop 13 is still in play. Can you
Yes.
speak to Prop 58 and other propositions that are not being sunsetted?
Right. So Prop 13 is still in place. The other propositions that are related to intergenerational transfers are not completely going away. They're just being changed as per the presentation. So in the slides, you'll see that there's new tax treatment for possible reassessment to property tax in an intergenerational transfer. I hope that answered that question.
Yeah, no, that was great. If people have questions, you can unmute yourself or post them to the chat.
Hi, I'm Rosemarie McNair. Can you hear me?
Yes, go ahead, Rosemary.
I have a question for Carl Warden as to they might have for someone who exceeds the allocation once they've purchased something and they have more than the, say if they're a married couple, they have more than the $500,000 exclusion. What are some of the things that you do? I know everybody has their own tax situation, but perhaps you could give some examples.
Yeah.
How to shelter yourself from having to pay a big whomping tax that you'd rather not pay.
Yeah, absolutely, Rosemary. A pleasure to talk with you. You obviously not talking about specifics, right? Your specific situation. There are ways, where you could actually capture tax-free basis out of the transaction tax-free. So you might have paid, for example, $200,000 for your property back in the, late 70s. You put in a, couple, $200,000-300,000, let's call it $300,000 for the capital improvements with roof, room addition, kitchen or bathroom renovation. You've got all this money into this property, this $500,000, and, the value is sitting up close around, 1.8 million. So, in that example, obviously you're getting the $500,000 exemption above and beyond your cost basis. So the total of that would be $1 million. But the problem is you have that $800,000 capital gains tax liability, and losing upwards of 30% of that means you could lose $240,000 of tax. So that becomes a non-starter for a lot of people. It's almost like, who cares about Prop 19 or Prop 13 or any of that? I don't want to give away a third of what I've worked for all my life. So the answer is, we have strategies that would enable you to capture the $500,000 out of the deal, which enables you to move anywhere in the state, or for that matter, anywhere in the country. And then the remainder of the money, which would consist of the difference between that and the 1.8 million, which is 1.3 million, could be captured in a trust, believe it or not. And this trust could be viewed as an extension of your overall retirement picture. So that's one option without going into big detail. Another option would be turn your house into a rental. This is probably one of the least appealing options, because if you're like most people, Rosemary, this is your home, and the last thing you want to do is turn it over to renters who are going to destroy the place. So, or at least that's the fear anyway. But you could, legally turn your home into a rental, and then you could actually exchange the property. Safe harbor rules suggest that you could exchange it 2 years later. Some CPAs, depending upon who your CPA is, feel comfortable that after getting it on 2 tax returns as a rental, that you could turn around and sell the property and then do a 1031 exchange. Here's the best part. The best part is that $500,000 exemption could actually come out of the property tax-free at the point of sale, assuming that you're, you were married and lived in the home for 2 out of the last 5 years. So that's another strategy. Another strategy would be something called an opportunity zone or an opportunity fund. And this is where we, just invest the capital gains into that investment. Again, without going into too much gory detail, minutia detail, probably better term. And then, conservation easement. There's a few different options for you, quite a few different options actually, for you to be able to keep most, if not all of this money working for you and your family. There's other things to take into consideration, Rosemarie. For example, did you inherit the property? When did you inherit the property? For those of you on the meeting here, maybe a spouse passed away. In that case, there's a step up in basis given at that point. You would get your $500,000 exemption, 2 years following such a passing. If you were beyond the 2 years, you still get your 250. So there's lots of things that we look at. It's a great question, Rosemarie. In terms of how you can, keep this money, there's a lot of different strategies. You can use each of these strategies individually or in combination with each other to help you accomplish your objective. And that's our wheelhouse. That's what we help you do.
Thank you. Do you see anything on the horizon as far as, I know there's going to have to be some ways to make the government to make some money. And I think taxes increases of some sorts. Do you see anything happening with the 1031 tax deferred exchange or stepped up basis or some of the tax shelters that we do now have that may kind of be affected?
Yeah, personally, I think that if they kill the step up in basis, I think that I think that the government, they might as well just take a gun and shoot it at their foot. I mean, it's a huge mistake. But part of the value of this country is based on the basis and the potential step up in basis that the beneficiaries would receive. In other words, the value of this country is based largely on real estate value. And so the problem with eliminating the 1031 exchange or step up in basis, hopefully we have some smart, savvy financial people in government. Sometimes I wonder, I think you do too. But part of the issue is that, you're going to devalue the country.
Hey, Carl.
Yeah.
Carl, sorry to interrupt you, but I found your stats the other day really interesting about 80%. Why don't you share those? About 80% of people have their money invested in real estate versus. Yeah.
So, the baby boomer generation, on your drive out and around today or out and about today, literally owns and controls about, 80%, or sorry, 50 to 55% of everything you see. They're, quite a wealthy generation. They were smart. They invested in business. They invested in real estate. If you were actually to put a for sale sign in the middle of the United States of America and sell it to Canada, for example, the going rate would be roughly 180 trillion, dollars, plus or minus $10 trillion. And that's depending upon what website you look at. Some websites will say over $200 trillion, which I don't think so. But anyway, and the baby boomer generation controls a little over half of that. So, do the math, 180 trillion times 50 to 55%. Basically, it's about $90 trillion that the baby boomer generation is worth. That's a significant portion of the value of our country, to say the least. So what's interesting is that if you continue to do your research, what you'll discover is that about 80% of the baby boomers' net worth is not in IRAs, 401ks, and cash. Actually, that's where 20% of their net worth is. Where 80% of their net worth is in real estate. It's in their primary residence, their second home, their investment property portfolio, right? Or their business. That's where the lion's share of their wealth is. So, frankly, this whole concept of killing the step up in basis, you're gonna destroy the value of real estate. The 1031 exchange, in my opinion, is a very necessary structure. I don't know, what they're thinking about even flirting with the idea, but that would have tremendous impact. If we're having to sell real estate and then give a lot of that money to Uncle Sam, that's going to have tremendous negative implications. So, but yeah, actually the reality of it is baby boomer generation, about 81% of them have about $250,000 or less in cash saved for retirement in cash, 250 grand. It's not enough to last 15, 20 years. And so, and the numbers, by the way, that 80% is somewhere between 25 and 40%, again, depending upon your research, if you do it, has zero. 25 to 40% have zero. And it's the other, 40% that have 0 to 250. Either way, it's not enough. But as I stated earlier, the lion's share of their net worth is not in IRAs, 401ks, and cash. It's actually sitting in their real estate. So, to have access to options and strategies and, buried within those 80,000 pages of the IRS tax code and case law is options and strategies for you to legally keep most, if not all, of the money working for you and your family. And so you just need to apply. And by the way, I'm not a CPA. I'm not a tax attorney. I do have them on my team. I don't do what they do and they don't do what I do. But when it comes to the disposition of assets, you need us both. So Rosemary, if you're even considering selling, let's have a conversation and, I'll help you understand what your options are.
I think I was asking the questions in general. Certainly, I'm not of the caliber to be worrying about $1 million gain. So
Okay.
Thank you so much.
You're very welcome.
Okay. Hi, it's Nicole. Does anybody else have a question? Or Cheryl? Hi. Hi, Cheryl. Jose in Mexico. Anybody else?
I don't see anything in the chat. So if anyone wants to post anything in the chat or go ahead and just raise your hand, either way.
I think it's fine. Maybe we're gonna do a wrap up and then Walt, are you there? He was there. Okay. Team Vista Properties, any questions? Okay, I think we're gonna wrap it up then. Is everybody good? Crickets?
Looks
Good
like
job, Nicole.
nothing in the chat.
Hey, there's been a recording of the call, so we can publish it out. And I think it was great. We have Rosemary, you have my email address, right?
I certainly do.
Okay, and then Walt, just email me, I'll send you a copy of the presentation.
Thank you so much.
I'm not sure who David is or DB. We've got some random people on here. Okay, well, anyone that wants a presentation? Okay. Thank you very much.
Thank you, Nicole.
All right, guys.
All right. Bye-bye.
Wonderful. Thanks, everybody. Have a great day. Thanks, Nicole.
Thank you. Great job, everyone.